stocks are over long term persistent. They behave. There's positive autocorrelation. In other words, they trend. Okay, they trend, and we know that stock momentum is a very interesting factor that's often used. But over short-term horizons, so less than 1 month, stocks are anti-persistent. In other words, they revert. And price reversals is effectively the models to be used there.
Hello everyone, and welcome to another episode of Resonance Spotlight, the podcast where we explore investment strategies, learn the story behind them, and meet the expert who create them. I'm your host Vincent, and today we are discussing a topic that has been generating a lot of interest among investment professionals: factor timing. Factor timing is about adjusting an investment portfolio to focus on certain factors like value, momentum, or quality based on what's happening in the market right now. The goal is to improve returns by choosing the factors that are likely to perform best in the near future. But why is factor timing so important at the moment? The reason is a unique market condition we are seeing. Traditional investment methods are being challenged because some factors that used to be reliable are now less stable. At the same time, the popularity of smart beta ETFs mean that factor timing, once used only by a few quantitative managers, is now a common strategy for both big institutions and individual investors. This has led to an important debate. Can factor timing consistently deliver better return? Or is it too risky in today's unpredictable market? Some people think that trying to time factors add too much complexity and risk, while others believe that with the right data and models, it can significantly improve portfolio performance. In today's episode, we'll explore these critical questions with our guest, Dan Jelicic, a seasoned fund manager and a pioneer in the field of factor timing. By the end of this episode, we hope to provide a clear answer on whether factor timing is a valuable tool to your investment strategy or if it's better to stick with a more traditional approach. Dan Jelicic is a Chief Investment Officer and Portfolio Manager of the Trium Avala strategies. With over 20 years of experience in quant finance, Dan has made significant contribution to the field, with his strategies earning multiple awards. Dan's pioneer work began in 2002 at Sabre, where he launched one of Europe's first quant equity market neutral funds. Before Sabre, Dan designed and managed the European equity market neutral fund at ABN AMRO and worked as a quant researcher at JP Morgan. So without further delay, let's welcome Dan Jelicic to the show. Dan, good to have you here today.
Thank you, Vincent. Yes, delighted to be here and that you are addressing this very important topic that was of great significance to me.
Yeah, so then let's start this episode by learning a bit more about you, and particularly, so what initially drew you to the world of finance and investment management?
Yes, in early days, indeed, I was training to be an actuary, and worked mainly in asset liability modeling. But there was a field that was of particular interest to me at that time, which was asset liability modeling, where I came across a first quant model, actually, which was modeling assets based on effectively inflation, and one of the starting point. I then realized that actually the asset side of things is a lot more interesting, and I then took a little risk in terms of moving on to investments and got a master's in quantitative trading and finance. That was in, say, mid-90s. And after that, I got a job in JP Morgan fund management as a quant researcher. I was lucky enough to there address a number of multiple asset classes, but mainly my emphasis was in equities and currencies. From there on, then I moved to ABN AMRO and so on, and then obviously moved on to see things that perhaps at that time were quite unusual, and maybe not seen by many others.
So were you already doing a quantitative job back then, or I don't know if the term was already widely used, or would you have described yourself as a discretionary manager? Or?
I was always thinking in that direction in terms of, say, how to use numerical methods to find solutions, which computers obviously are of great help there. But when I moved on to asset management in JP Morgan, JP Morgan was indeed in using quantitative tools. And I was part of the quant group, research group, which was developing tools for them.
You've been pioneering the factor timing, or what's also you used to call at some point maybe the style arbitrage approach. So how did you get there? Was there a particular a moment, the tipping points, or was it a gradual evolution from?
Yes. From JP Morgan, I moved to ABN AMRO Asset Management. And there I had two roles. One was strategic advisory, which was based on my actuarial skills, helping them producing models for long-term pension funds, advising directly the CIO. But the other one was alternatives group, where I was when I was actually doing product design. So one of my first roles was, ABN AMRO had very good internal analysts. And essentially the main thing I did was to produce a value overlay, which was dynamic. In a sense, I realized that because of a lot of persistence in value factor, I could switch that off and on with a lot of confidence in being successful in doing so. And that was the product I designed. So the next step was, who's going to manage this product? And the CIO offered me to manage it. And that's where I said yes, and I started managing this product. This started in June 2020, and it turned out that it was after the major inflection points from growth to value. But it made me realize, A, that factors can be timed, and B, that with a little bit of more quantitative screening, you can actually input an awful lot of other factors and build my own product, which is basically how I went to SEBA. SEBA wanted somebody to run factors. They already had a quite successful startup product, and they wanted somebody to run factors for them. And I started style arbitrage in 2002. So Which is very interesting because, firstly, because of the topic of the conversation, and also because of some recent academic papers that have been written calling them, on factor momentum. So that's how we that's how we started back then.
Okay, great. Before we dive deeper into really about factor timing, maybe just taking a step back, can you just describe for us the idea behind your style factor performance persistence,
Yes, of course. Okay, let's go back to the basics here. Okay, what are the factors? Factors essentially are groups of stocks built around certain attributes, that these stocks have in common. For example, book to price. So what we do is we construct effectively long-short portfolios where we go long cheap stocks and short expensive stocks. Okay, so around so many multiple factors can be built around many other different attributes like this. And we can then look at the behavior of these factors and behavior of stocks, and what is the difference and what are the commonalities. Okay, so we look at this. Usually I draw a quadrant with short-term, long-term horizon and stocks and factors, but I can describe that quite easily here. Basically, stocks are over long-term persistent. They behave, there's positive autocorrelation. In other words, they trend. Okay, they trend. And we know that stock momentum is a very interesting factor that's often used. But over short-term horizons, so less than 1 month, stocks are anti-persistent. In other words, they revert. And price reversals is effectively the models to be used there. And, in particular, a very lucrative area of market neutral investing is startup, which indeed is just focusing on short-term time horizons, sometimes intraday time horizons. Okay, yes. Overall, below 1 month, stocks definitely revert, and over 3 months and onwards, especially 6 months onwards, they definitely trend. Now, what is the situation in factors? Now, factors, as I said, is just groups of stocks. So you'd expect, okay, maybe they behave the same way, but they actually don't. Over the long term, yes, they do. Okay, factor trend. But over short term, or less than 1 month, factors also trend. In other words, there is this positive persistence, positive autocorrelation, even over the period of less than 1 month. Okay, now that was very fascinating to me back then, and it's still fascinating to me now. Now, why is this? Okay, so there is enough explanation, even in the literature back then, what's going on. Why do we have trends? Well, some people have better information than the others, start the trend. The others get the information later, jump onto this again, and then so on and so on until people buy just because they've seen something's been going up, and you basically get these herd effects. So this is very much true for most assets. In fact, if you look at Bitcoin or something like that, which trades purely on sentiment, but in terms of stock factors, definitely is the case, but not for individual stocks.
So what's your approach to time factors?
Okay, so because most factors, but not all, most factors have positive autocorrelation. The techniques to exploit this basically make money out of positive autocorrelation. Okay, so what are these techniques? Most obvious one is econometric models, like a Riemann model, for example, but also trend following models, which are commonly used in currency. Remember, I mentioned that I've seen how currency traders exploit trends in currencies, and furthermore, I came across, I met a lot of interesting people who had a very good idea about that, and that's basically what we're doing. We're looking at, back in 2002, I started effectively looking at trend following models such as MACD, moving average convergence, divergence models. And I'm pleased to say that is still being used. We have, of course, expanded over the period of years, adding number of proprietary models that best capture the time series as well as cross-sectional properties of factors. But this original approach is still here, and I think that's still working very well. So I think what's also important is very careful implementation. One has to be very careful and not overdo it. Like, you can find that you're always, by necessarily overweighting certain factor more and more and more, you're going towards more concentration. So you don't want to lose the benefit of diversification at the same time. So it's a trade-off between adding alpha, making factors better and losing a little bit of diversification. So that's why, this complexity, people maybe get over concerned about the complexity of doing this, because you really need to know what you're doing. And what are the real issues with this? Okay, of course, the complexity I mentioned to some extent a little bit earlier, in the sense that it's a cross-sectional issue. It's not just a single factor issue. You have to be careful in blending this with respect to not losing the effects of diversification. Okay, that's one point. Some obvious points are also there in terms of cost of implementation. I did, over the years, come across a number of papers, and I'm sure academics have been noticing and have been producing papers saying that, yes, there is positive autocorrelation, but it's hard to exploit it because of the costs of doing that, because, of course, you need to trade a lot of stocks to do this, okay? And I've seen some large assumptions for costs in academic papers. So for people like us, seasoned investors who've been around, the costs are much, much, much lower. But of course, it's true, if you have a 10 billion plus portfolio, right, you will be struggling to perhaps optimally do this in terms of what you would be optimally find at 1 billion portfolio. Okay, because it does take some trading, and of course, if you're going to move the market, the other people are going to front run you. Okay, it's simple as that. It's also, these effects are probably getting stronger down the size curve. So I say it's probably a little bit stronger at mid caps rather than large caps. So you can't just say, oh well, I'm only going to do it for the top 100 stocks, because of course you can do that. Yeah, it's size, but unfortunately the effects are not as strong as for the lower 1,000 stocks. Yeah. So there are these costs that are actually a little bit difficult, but even if you're 10 billion, you can still probably do it somewhat, but at a smaller scale. Other issues that can be a problem is overtiming. I mentioned it earlier, but I'll say it again because it's very important. People can see the autocorrelation, but if they go too much into this area, there is a risk of concentration, of too much concentration, and actually not helping the overall Sharpe ratio. And a final point, I should say, is the inflection point. Okay, that has always been the case, when basically momentum breaks down. Of course, if you are now overemphasizing value, and value breaks down, you will be losing more money than if you just had a static exposure to value. So how do you protect against that? Okay, that I think is a big problem potentially for investors. And I'm not just talking about factor timing. So far, we've been talking about factor timing based on persistence, which I'd say would probably one of the main areas for factor timing, but I've seen a lot of other factor timing models. You can, for example, use valuation spread. You can say quality looks very cheap at the moment, so we should overemphasize quality. You can also look at volatility of factors. You can say, I'm going to emphasize the low vol compared to high vol. So, so overall, either one of these cases, you can find that, in the end of the day, you have this potential inflection point, which is the risk. So overall, yeah, I would say these are the main pitfalls.
Right. Yeah. So you mentioned a lot of quant techniques. When you talk about econometrics and your actuarial background and covariance metrics, but I haven't heard the word machine learning or AI. So, is there a particular reason for this?
Not really. I mean, the question is a bread and butter question for me about exploiting effectively the herd effects in factors. And now we have a proliferation of factor strategies and even stronger herd effects. So I'm kind of getting quite excited because it's my pet topic and I know how to exploit it. But is machine learning helpful? Potentially, but I think we're not saying no. We're agnostic to machine learning, of course. And we indeed have some models that are looking at stock level machine learning stuff that exploit some nonlinear properties in stocks. But this is stuff that herd effects that are really best captured by the models that have been tried and tested over many years and enhanced over many years as well. So we feel we have a strong understanding of what's going on there. Besides, in terms of AI, which is obviously making a huge impact in other parts of the world, I'd say for quant managers, these machine learning techniques have been around for many, many years because we simply deal with data. I think the trick here is that people have managed to create data out of things that outside the financial world, where there was no data before. Natural language processing for text and various other data collection and so on for various other things in medicine. Amazing, and so on. But for us, we've always been dealing with data, so we already have been dealing with numbers. So we already had that first step that people are finding out in different areas now.
And what future trends do you foresee in quant equity investing, particularly concerning factor timing?
It's very interesting. Going forward, okay. Plus ça change, plus c'est la même chose. Okay, just to use French summary of this. I think what we've seen over the years is essentially we're coming back to the same thing. People do not change behavior that easily. We can see that in the case of Bitcoin. Okay, what is Bitcoin? It's entirely sentiment driven, but the trends in Bitcoin are enormous. Okay, just because people follow these trends, it's a herd effect. It's asymmetric information that I mentioned earlier. And what we are now seeing in factors is very much the follow-up story on trends and people observing factor and effectively jumping on factors when they see it working and causing more herd effects. Even the big rotation people are talking about, it's very much now it's coming up. When it's coming up, are they going to cut interest rates by how many cuts and so on? The big rotation, as you know, they're talking about from large caps to breadth of the market to the diversification and finally good opportunities for stock pickers to add value. That's effectively an example of the factor rotation. It's an example of what we've seen since 2021 is massive outperformance in large caps for 3 years now. And what we expect to see once this turns, and it's starting to turn already, like we are now close to, but it's quite a mild inflection point. We're going to likely to see a years of continuation of the performance of mid caps and small caps. Okay, so we need to see some evidence in terms of course, it's all of this is linked to the economic regimes. Okay, so yes, when interest rates are low, it's good for small caps. When they're high, large caps. But people jump on this before and cause this trend. So it's very hard to actually use economic models to forecast this. Anyhow, for ultimately the understanding behind this. But what we are now seeing is potentially star rotation. Also, what I would say is the emphasis and the popularity now with factor timing is possibly going to create even stronger trends. Okay. Now, what goes with stronger trends, of course, is we might even see the inflection points that are even stronger, which is bad news. Like when we have big reversals of these trends. I should say that for us, that's probably good news, because I need to say a few things about inflection points. Inflection points can be quite bad, but in terms of what we do, we effectively use the price reversal models. Earlier on, I was talking about opportunities for stocks that do revert over a short period of time. Well, if the factors revert as well over that quick turnaround, then the effects for stocks are even stronger. So because we exploit that already, at that time when we need it most, the price reversal model works at its best. Okay? So examples of that, say November 2020 or March 2009 or August of 7. I've been around for many years and I can remember all these things. And price in all of these inflection points, our price reversal models have done very well to protect the fund from it. And I think that's one way of doing it. Of course, you need to run them simultaneously. And again, for very large managers, it's very hard to do that because obviously it's a lot of trading as well over short to capture that anomaly as well. But overall, exciting times because we expect, if anything, stronger factor momentum.
Dan, thank you so much for sharing your insight and experiences with us today. It's been a pleasure having you on the show.
Thank you. I really appreciate the opportunity to talk about my pet topic.
Thanks. And to our listener, thank you for tuning in to another episode of Resonance Spotlight. Stay tuned for more expert insight in our upcoming episodes. Until next time, I'm Vincent, and this is Resonance Spotlight.